Nuburu Inc., ticker symbol BURU, is trading live on the NYSE American at $0.26. That is a drop of $0.012 or about 4.47% on the day, just before 10 a.m. Eastern Time. The stock is floating just above its intraday low of $0.25 on volume that is already climbing past 12 million shares, well on its way to its daily average of nearly 60 million. Now, for a stock trading at 26 cents, a 4.5% drop is almost meaningless. It's a rounding error. And that right there is the immediate, unanticipated insight. The question you should be asking isn't, why is BURU down 4.5% today? The real question, the one that should be consuming anyone who has ever looked at this company, is, how is this stock still listed at all? The expectation, born from a high-tech SPAC, special acquisition company, promise was that this was a gateway to a new industrial process. The reality, at 26 cents, is that we are not watching an investment, we are watching the final flickering embers of a corporate campfire as the last bits of wood turn to ash. Let's establish the common ground, because this company had a fantastic story. This was the Blue Laser Company. Nuburu Inc. was presented to the market as a high-growth, disruptive force. Its technology was and is legitimately interesting. The company designs and makes high-power blue lasers. Why blue? Because, as physics dictates, materials like copper, gold, and other yellow metals absorb blue wavelength light far more efficiently than the infrared lasers that dominate industrial manufacturing. This, the story went, made Nuburu's technology a perfect solution for the new economy. Think about the explosive growth in electric vehicles. Their batteries require welding thousands of copper connections, a process that is notoriously difficult with infrared. Nuburu's blue lasers promised spatter-free, high-speed, high-quality welds. This was a picks and shovels play on the entire EV boom, from Tesla stock all the way down. It wasn't just EVs, it was 3D printing, consumer electronics, and medical devices. It was the kind of story that gets retail investors on the Robinhood app and SoFi Invest platforms excited about online investment. It was the dream of self-investing. Find a small company with a critical piece of technology and write it to a 100x return, like getting into NVIDIA stock in the early 2000s. Now, let's challenge that narrative with the ice-cold, brutal reality. The expectation was a high-tech future. The reality is a 26-cent stock price that tells you everything has gone wrong. This stock is a graveyard of capital. It came public via a SPAC, and, like so many others, the promises made in the glossy presentations have met a catastrophic end. This isn't a dip, this is a collapse. Let's talk about what's really been happening, because it's not about today's 4.5% drop. The real story is the non-stop fight to just stay listed on the stock exchange. Back in May of this year, Nuburu received a non-compliance notice from the NYSE American. The reason? Its stockholders' equity had fallen below $2 million, and its report card from its own auditors included a going concern qualification. That is the single most terrifying phrase in finance. It is the auditor's official way of saying, we have substantial doubt that this company will be able to continue its operations. But it gets so much worse. To fight this, to get the stock price back over the $1 minimum bid requirement, the company did what all dying companies do. It executed a reverse stock split. In June of 2024, they performed a 1-for-40 reverse stock split. That means for every 40 shares you held, they took them and gave you back 1. This magically turned a, say, 10-cent stock into a $4 stock. But it didn't create any value. It's like cutting a pizza into one giant slice and pretending you have more food. The market, which is not stupid, saw right through this. The stock immediately began its relentless march back to the bottom, and here we are, at 26 cents, right back where we started, having wiped out 99.9% of post-split investor value. This isn't a stock you'd ever find in a professionally managed Schwab Intelligent Portfolios account or a stable Fidelity retirement fund. This is the definition of speculation. And the hits just kept coming. In October, just last month, the company received another warning letter from the NYSE. This one was almost comical if it weren't so tragic. They were being reprimanded for not giving the exchange proper advance notice before announcing material news, specifically their new dual CEO structure. This points to a level of internal chaos that is staggering, but even that is not the killing blow. The real company killer was buried in their SEC filings, specifically the notice of non-compliance back in May. In that filing, the company had to list its risks, and it included this one: the impact of the previously announced foreclosure, which resulted in the loss of the company's patent portfolio. Let that sink in. A high-tech laser company whose entire value proposition was its unique proprietary technology lost its patents in a foreclosure. It's like Apple stock losing the patent to the iPhone. At that point, what is the company? What is left to even sell? The financial reports are, as you'd expect, horrifying. The last quarterly report for the period ending June 30, 2025 showed the company had just $111.90 in cash and cash equivalents. Not $111 million, $111,000. That is not enough to make payroll for a week, let alone run a high-tech manufacturing business. The company's accumulated deficit had ballooned to over $150 million. This is not a growth stage company reinvesting for the future. This is a patient in critical condition, and the heart monitor is flatlining. So, what is the plan now? This is where the story gets truly desperate. The company has announced a transformation. Having lost its patents and burned through all its cash, the blue laser story is effectively over. The new story, announced in a flurry of press releases in September and October, is a pivot to defense tech, security, and critical infrastructure. To fund this, they executed a $12 million public offering in September. This was an act of pure survival, selling stock at presumably pennies to raise just enough cash to keep the lights on and try to buy something else. They've announced a new dual CEO structure, a strategic alliance with a company named Maddox Defense, and plans to acquire other small companies named Techni and Orbit. This is the Hail Mary. This is a company with 26 cents to its name, with no core business left, trying to use its public ticker symbol as a lifeboat to board other, hopefully less sinking ships. Traders on Interactive Brokers are likely just day trading the volatility, knowing the company is on its last legs. Let's frame this with our expectation versus reality model. The expectation, the one sold in the SPAC, was that online investing could get you in on the ground floor of a company that would be a critical supplier for the EV and electronics revolution. The expectation was high tech, high growth, and a massive addressable market. The reality is a 26-cent stock. The reality is a company that lost its patents. The reality is a company with $111,000 in the bank and a going concern warning. The reality is a failed 1-for-40 reverse stock split, a slap on the wrist from the NYSE for not following the rules, and a last-ditch desperate pivot to defense tech by trying to acquire other companies. The $12 million they raised isn't for growth, it's for the acquisitions that they hope will replace the business they already ran into the ground. Here's a question for everyone watching, especially if you've ever been tempted by one of these high-tech SPAC stories. For anyone who's ever traded a SPAC, comment below with your experience. Did it feel more like investment or gambling? Looking forward, the bull case, if you can even call it that, is a pure miracle. It's that this new defense tech pivot, funded with the dregs of their last capital raise, actually works. It's that one of these acquisitions, Orbit or Techni, turns out to be a hidden gem, and that the $12 million is enough to get it to revenue. This is not a high-probability scenario. The bear case is simple, logical, and staring us in the face. The cash runs out. The $12 million is spent. The new acquisitions fail to generate a profit. The company is delisted from the NYSE American and moves to the OTC Pink Sheets, where it will fade into total obscurity. The stock goes to zero, and every single person holding it on their Robinhood stock trading platform or in their Fidelity brokerage account sees their position become a total loss. In summary, as we watch Nuburu Inc. trade for 26 cents, we are not watching a company on a bad day. We are watching the final agonizing chapter of a failed company. The expectation of a blue laser future was bright and compelling. The reality is a corporate shipwreck, a story of cash burn, lost patents, and a desperate scramble to find a new identity before the ship sinks beneath the waves. This isn't a buy-the-dip opportunity. This is a cautionary tale for anyone in online investing about the profound difference between a good story and a good business. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional.